Good morning, everyone. Welcome to this update for global stocks and commodities for the 19th of November. I've titled this week's video Living in a Financially Distorted World because that's certainly what we have been increasingly in since 2009 with the incredible central bank policies that are an experiment. We've never been to this place before, so no one really knows how it's going to play out. I think it's worth reminding ourselves that we are in a world that's just so financially distorted and different from anything that we've ever seen before. But it doesn't necessarily mean that we need to be fearful of it. And there are numerous indicators that you can watch that will indicate when perhaps markets are have had enough of this bull market phase and are rolling over. So in this update, I'm just going to do a bit of a quick recap on the advanced warning indicators that I introduced last week. And if you didn't see last week's video, go back and take a look at that because I think it gives a good summary of what's important. But the key message I want to get across is that we need to be acting on what the charts are telling us and not what the fundamentals would suggest should be occurring, because we've been in that position now for quite a number of years. There's been people calling tops in the market since 2013, and here we are 4 years later, and the S&P has advanced enormously, and there's really no end in sight. And certainly the fundamental picture has got a lot better in terms of global economics. Also be looking just at the normal stock and commodity trend updates. Portfolio Analyst last week, we covered spotting great breakouts, and I showed a number of examples of how you can see breakouts that are building before they actually occur and how to play them. We looked at Aussie tech stocks and quite a few good stories there. There was a bit more on lithium and solar as well. If you would like to avail yourself of a 2-week trial on Portfolio Analyst, that's still available. Not sure how much longer we're going to continue to do that, but it is still there if you want to go back and check what has been done in the past. So let's have a look at the key things that I'm monitoring, and for those of you out there that wish to do the monitoring yourself as well, then fundamentally the key things are that we get a rise in short-term bond yields, and at the moment the long-term bond yields are staying very stable, and so it wouldn't take very much for us to get to a situation of what's called an inverted yield curve, where the short-term rates are higher than long-term rates. And that's certainly bad for financial institutions and therefore generally bad for the stock market. We're heading in that direction, but we are not there yet, and there's no guarantee that we'll get there. So there's no need to act on that, just observe it. Now, the junk bond market is one that I also pointed to last week. That's very important if the junk bond market really started to unravel, and fundamentally there's every reason why it would. But to date, that hasn't happened, and that's been the situation now for a number of years. So the junk bond market through the ETF with the code HYG is well worth watching. Credit default rates, of course, if the junk bond market does fall over, then the number of companies that have borrowed excessive amounts of money will also start to run into real problems. And there's an absolute avalanche of debt that's due in the next couple of years. And if the junk bond market falls apart, those companies would not be able to roll that debt over. They would have to default on their debt, and that could quickly snowball into a very ugly situation. And finally, and I talk about this all the time, major market tops are marked by a progression through to a stage of euphoric sentiment about stocks. And we're certainly not there yet. I think we're just getting into the early stages of people starting to accept that we have a bull market, and then that may take a year or more, or to even 2 or 3 years to develop into a more euphoric sentiment. So no reason why we should be concerned by that at the moment. What to monitor technically, of course, is a sudden increase in stock volatility, and we've seen none of that yet. And from time to time, I go back and I look at the changing character of the market that led to the tops in 2000 and 2008, and there's nothing remotely on the horizon that looks like that. And until there is, then the bull market will continue. It's pretty much as simple as that. Now, I ran across some charts that were really interesting, and they're very big picture stuff. I thought I would share them with you because it is an interesting perspective. Now, you wouldn't want to pin your hat on these particular charts and say, well, because that happened in the past, then that's what will happen this time. You should never do that. But it's just an interesting perspective because a lot of people are concerned that this market has been running for as long as it has. So this is a chart of the S&P index going back to 1929. So this is 90 years almost of market action. And what you'll notice is that the crashes of 29, 31, etc., the 1930s, depression, were actually a rising triangle in the end. You get the initial crash, and then we get higher lows, and then eventually we got a breakout. And the breakout occurred around about 1950. And the next peak did not then occur until around 1971, 72. So that was quite a lengthy run. And if you take it from the most significant recent lows, which occurred in 1942, then that's actually a very, very substantial run from 1942 to 1972. So nearly 30 years from the significant bottom to the peak. And that's why it's just so laughable that people are getting anxious and calling an end to this bull market because it's been running for 8 years. There's certainly precedent in the past for that not to be an issue. There was then another considerable consolidation with there was a significant market sell-off in 1974 to 76. And then we got another major advance, which effectively went from 1976 at the lows. The breakout occurred in 82, but ran then all the way to the top in 2000. And then you can see where we are right now. So this is the 2008 lows. We've been running for just under 10 years. We've been running for 9 years now. But look back here, 30 years from the low in 1942. And then from the low in 76, another 24 years. So there's no reason why this bull market cannot continue for quite a considerable period of time, another decade or more. Now, that's not to say that it's going to continue in the way that it has with incredibly low volatility, but it's just a perspective not to get confused between short-term signals and a long-term perspective. Now, just zeroing in a little bit more, and this is the New York Stock Exchange Composite Index, so it's different to the S&P, but nevertheless, it's tracking the stock market in general. And it shows here from 65 to 82 was an 18-year consolidation, albeit had a substantial correction in 74. But then from the breakout, we then got an 18-year advance to the top that occurred in 2000, 2002. And then 19 years in this current consolidation, and we're just breaking out of that. So it's really showing the same thing as the previous chart. So if this is true, then it's possible that we could just be at the start of a major breakout rather than the end of a bull market, which everyone seems to be completely fearful about. So I hope you just keep these perspectives in mind. They're very big picture. You wouldn't trade off them, but hopefully it'll just, those that are nervous out there that this bull market's been going for so long that it's going to end up in a significant crash sometime soon. Yes, there'll be corrections, 5%, 10%, perhaps even a bit more, and they'll be a little bit scary. But in terms of an end to the major secular bull market, there is absolutely no reason why that has to be. And as I said, a perspective is that we could be at the start rather than at the finish of a major bull market. So let's move on and look at American stocks. The S&P edged down just a couple of points. I think it was 3 points on the week. The earnings season is effectively completed. It was as good as ever. So that's the good news. And even better news is that normally at the completion of earnings season, companies have lowered their forward estimate. And that's because it's a game that they play in America where the companies put out low estimates and then they come out and beat them and the stock prices go up and everyone's happy. This year, the companies in general have been raising earnings estimates. So that's an indication of growing confidence in the economy and their ability to deliver to it. So that's a very positive sign. Walmart, that I'm sure you've heard of. It's one of the biggest companies in the world, and it certainly is a major reflector of the health of the American economy. They beat on both top and bottom lines for sales growth and profit growth, and they also raised guidance. So right there is a pretty good indicator of where the American economy is at. Now the tech sector, the earnings were up nearly 20%. And within the tech sector, the strongest subgroup was semiconductors, which were up 46%. And that's where certainly we've made a lot of gains this year in tech and in semiconductors. And the earnings growth also in those sectors has been very, very strong. So the earnings growth for semiconductors and tech sectors is certainly supporting the stronger share prices. Now, the overall PE for the market stands at 18. That's for the S&P. The long-term average is somewhere between 14 and 15.5, depending on what time period you base it on, whether you use 5, 10, or 20-year averages. So there's no question we are above the long-term averages in terms of the PE ratios. However, and I hope I don't sound like I'm making excuses here, you have to remember that this is relative to record low interest rates. And at the end of the day, financial markets will behave according to self-interest and where people can get the best rate of return. So you can use whatever financial metric you want to make a case, but at the end of the day, people will put their money where they get the best return. And with interest rates so low, the differential between the return from stocks and the return from fixed interest is still sufficiently wide that people will continue to be in stocks. So therefore, a PE of 18 is an interesting number, but because interest rates are so low, there is no reason why the market needs to come down from that. And with strong earnings growth going forward, there's every reason that the market can continue to advance. The breadth remains strong. We had some weakness in the Russell 2000 and the Dow Transports, which was a little bit of a concern, and I referred to them last week. But both of those rebounded in the week just gone. So the breadth remains good. The US dollar had been going up strongly. It was slightly weaker, but this is just part of 2 steps forward, 1 step back. So let's jump in and take a look at some charts. We'll start with the S&P, and you can see we're still above the 50-day moving average, which is still rising. It's not rolling over relative to the red 200-day moving average line. So there's just absolutely no change there at all. And you can see the daily ranges are quite small, so we've got no increase in volatility. In short, there is just nothing there. We're getting a little bit of consolidation in the index, but that's all it is. A bit of a consolidation to allow the prices and the 50-day moving average to converge, and then chances are we'll be off again. So I think the charts are telling us that the path of least resistance is higher, and therefore there is a greater chance that we'll see higher prices in the near term than lower prices. It's not a prediction, that's just an observation from what the charts are telling us. Now, could we get a bit of a correction, a bit of a bigger correction to the downside, perhaps down to 2,500 points? Absolutely. In fact, I wouldn't be surprised if we don't see that in the next couple of months. But you can't, or you shouldn't, trade or invest for that occurrence because it may not occur. We may just consolidate here and then move higher. Now, just looking at the NASDAQ index, so this is the QQQ, which is the ETF, because it gives us volume as well. And again, nothing untoward. We basically set new all-time highs during the week. The bigger volume spikes, as you can see, the green bars down below here, the bigger volume spikes are on the up days. So it's still very, very positive at the NASDAQ level. If we look at the Russell 2000, this is IWM, which is the ETF covering the Russell. You can see they were all-time highs in the Russell back here in October. We started to slide. You can see the 50-day moving average had rolled over. The price was below it, but we had a nice rebound and on some decent volume as well. So that was pretty encouraging, and the Russell outperformed on Thursday and Friday the other major indices. So good bounce back there in the Russell. Looking at Dow Transports, that's also one that certainly bears watching. We got a very nice rebound on Thursday. It gave back most of that on Friday, so it's still in a situation where the Dow Transports are underperforming. But look, the 50-day, the price is still above the 200-day moving average. It's starting to flatten out a little bit, but that's okay. We can get periods of consolidation as long as we're not starting to get wild swings in volatility. So when we start to see days like this one here on the 27th of July, or this day here on the 17th of August, when you start to see 3 or 4 of those in a row, bang, 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 one after the other, then you're seeing a change of character. There's no change of character here yet, but it certainly bears watching. Now, the other chart that I'm watching very closely is HYG, which is the junk bond ETF. This is on a weekly basis. So last week we were looking at this little breakdown. We broke below the lows of the 11th of August, but managed to put in a pretty nice reversal. So found some support. We had a bit of a rising triangle running there. We've broken that, but we still managed to hold support and quite a nice turnaround into the end of the week. So the junk bond market finished the week in much better fashion. Just while I'm here on the American market, let's look at the US dollar index. So we've got higher highs and higher lows at this point in time. As long as the index holds above 92.75, then we'll continue the uptrend in the US dollar. Turning now to Australia, the Aussie dollar fell despite the fact that the US dollar was also down. So we lost ground against all currencies, and we were down to 75.7, and that was, of course, largely around a continuing stream of less than ideal data. This time it was wages growth was pretty low, so that's really taking the steam out of the likelihood that the RBA will raise interest rates. We've got supports on the Aussie dollar, 73.5, 71.5. So they're the next areas of support. And certainly in the medium term, the Australian dollar is now heading down. Now the ASX 200 index was down 72 points on the week. We managed to break above 6,000 the week before, but it was very, very short-lived, and we're back down under 6,000 points. And basically it reversed all the gains of the prior week. So let's take a look at the ASX 200. So there was our breakout the week before, but then sharp move down, a little bit of a hesitant recovery Thursday and Friday, but the way that the banks and a lot of the other major stocks are looking at the moment, it's really hard to see what's going to sustain this above 6,000 points. Just while I'm here, let's look at pressure. I'll just look at the Australian dollar. So the Aussie dollar. So there was a key resistance level, 78.5. We managed to get above it for a month or two, got up to 81, but now we're looking at being well and truly back into this big trading range that was really in force. It's been in force now for in excess of 18 months. So we're likely to see some support here and then some support down here at 71.5. Turning now to precious metals. So gold, you can see, had quite a good day on Friday, popped up by nearly $20 on the session. And if we go to the weekly, you can see that we certainly have a rising triangle being formed here. This is quite a big picture because this is a weekly chart. So there's definitely a rising triangle there in gold, but no breakout yet. And but we are in the medium to shorter to medium term. We're forming higher highs and higher lows. So you're probably entitled to be very mildly positive towards the precious metals sector. Let's look at GDX. You can see still no real change in GDX. The last 3 or 4 weeks has effectively just done nothing. It's just sitting here around about this $22.5 to $23 level. So just completing on the Australian market, I think if you want to make progress in Australia, you've got to be looking outside the top 100. And there are some great performances and some terrific unfolding stories outside that top 100, but that's where you got to look. So gold up by 18, and the sudden strength which occurred on Friday obviously was well beyond currency effect. Now GLD holdings, which is the world's largest ETF, are still sitting unchanged at 843. And precious metal stocks, still nothing really doing there. I've talked about, certainly to members, about Northern Star. I've been talking about that as the best gold stock in the world for about 5 or 6 years now, and that's not just an opinion plucked out of the air. That's just based on, I guess, two things. One, the progression in financial metrics is exemplary, and secondly, the company meets or exceeds every single target or objective that they set. And when you do that quarter after quarter after quarter for 5 years, then it gives you a high degree of confidence about what the management is saying for the upcoming period. The fact that Northern Star is now trading very close to all-time highs, there's hardly another, there's not another gold producer on the planet that I know of that is in that position. Most of them, their gold price is well below their all-time highs. So if you want to get some exposure to precious metals, then look no further than right here in our own backyard. Copper eased another couple of cents. Crude oil also eased very, very slightly. But as I said last week, a new uptrend after reaccumulation has started. And I would expect to see in the not too distant future oil above 60, and then longer term, as in several years out, we could be headed back towards the $90 area. There's the spot copper chart, not much change there. So to wrap it up, I think it is certainly worthwhile keeping tabs on the fundamental concerns, and I do that on your behalf constantly. But overall, act on the charts, and the charts are saying at the moment that there's nothing to be concerned about. There is absolutely no sign of a change of character going on. So stay with what is. Portfolio analyst this week, we're going to be looking at some opportunities in artificial intelligence. And also I've had a question on how I construct my watch lists as well, which is interesting. So that's the rundown for this week. Here's my contact details for those that would like to get in touch with me, and we'll be back with you next week. Cheers.